Hear ye, hear ye. I know the court gestures and the jokers like to come out when the VIX spikes into the 60s and that black swan prediction finally comes true. But now that the VIX has fallen back below the 20s and even into the low teens, it's time for the king to come back. And so I was looking at who's the king of the actively managed ETFs right now. Who's the king? Because everyone looks like a genius during a bull market. But I've got a little time frame after a bit of a correction here. And I want to see what these fund managers are able to do during a trough. Yeah, when there's a big trough and everyone's scared about what's going to happen to a trough because of a Japanese bridge currency. Yes. So I want to see what you can do during that time. So we're going to see that there's been a clear winner. I can't think of a better one. So we're going to go over the results. I'm just going to give you the numbers. And I know a lot of you guys like to live in this fake reality where dividends don't exist. Dividends are scams because your fund manager and your employer tricked you to putting all your money in a 401k that yields nada, that you can't touch until Valhalla, and you think you're going to retire on that because you get a match. And that match is free money. Oh yeah, it's free money. Okay, so go ask for it. Go ask for your free money. You can't. So a lot of people, and a lot of CFAs especially, they'll look you dead in your face if you talk about an 8% yield and say, oh buddy, this guy got suckered. He just bought some snake oil, because they need that to be their reality. They need to believe there's no way to get a dividend higher than 11% unless someone's taking a crazy amount of risk. Someone is, not even tracking the market. They're selling options on AMC or something like that. They need that to be their reality, no matter how disproven it was. I had someone who worked for the company that made JEPI and JEPQ ETFs while they were yielding both over 8 to 9% in the 10 range tell me maybe a REIT could get you 8%. I said, what about your own company's funds that they have right here? He was like, oh, okay. Anyway, fund review. King XDTE and the Knights of Roundhill beat SPY while yielding 34.88%. Paid out weekly. This is presented by Puppy Trades. This video is for entertainment purposes only, and it's not investment advice in any way. But it is stuff that I use as part of my analysis for why I have bought QDTE in the past and why I bought XDTE. I took a starter position for the first time this week while back testing live. So let's see what this fund is all about. What are they doing here? Let's take it from the horse's mouth. The Roundhill S&P 500 Zero DTE Covered Call Strategy ETF is the first ETF to utilize 0 days to expiry 0 DTE options on the S&P 500. XDTE seeks to provide overnight exposure to the S&P 500 and generate income each morning by selling out of the money 0 DTE calls on the index. XDTE is an actively managed ETF. It makes weekly distributions paid out from sold option premium. So not paid out from the company's dividends themselves, not paid out from ExxonMobil, not paid out from Apple, not paid out from JP Morgan, paid out from option premium. So when people think all dividends are traps, they don't really matter, they're irrelevant, an option that expires out of the money and the premium was collected, that's relevant. That's relevant. So someone who collected a 0 DTE option premium on a day when the S&P 500 was flat, negative, or just didn't hit the strike price, they did better than someone who just owned the S&P 500 that day. So they got a premium for it. they got something called a dividend, and that dividend wasn't irrelevant. And it definitely wasn't a trap. We'll get into that too. High income potential. XDTE seeks to generate high income through a covered call strategy on the S&P that harnesses volatility through mispricing, this inherent mispricing of the options market. We'll get into that. XDTE sells 0 DTE options on the S&P 500 and seeks to exploit structural market mispricings. The biggest devil's advocate for this ETF is that it's got an expense ratio of 0.95, which is compared to the S&P 500 SPY's expense ratio of 0.0945. And of course, the purists will say, well, what about VOO? VOO's got a lower expense ratio. You can throw VOO in there too. We'll see if this fund is worth it. How is it generating this exposure though? Why is this fund doing better than ISPY from ProShares that owns the S&P 500? It owns the shares, and then it has swap contracts sell the 0 DTE option. Why does this ETF have such a higher yield and better total performance? We'll answer that question in this video. So how are they getting this exposure? Because a lot of people are going to focus on the sell side. It's really with this ETF how they're getting the notional exposure. And this is where a lot of people, they don't understand options or Greeks. They'll say things like, I'll never trade options ever. I'll never trade options ever. Okay, this fund is going to do a good job of explaining why, while yes, there are extra risk associated with trading options, smart, active investors do not just blindly make these statements. Oh, I'm never going to trade options. And even if they do, they definitely know about the Greeks, and they definitely are going to understand why this fund is able to do what they do. Look at this. Look at this. It's paying 38 to 40 cents to 35 cents a week. And also look how quickly, look at how quickly the yield adjusted to the volatility. Isn't that very interesting? As the volatility spiked from July 24th to 31 to 8.7, we saw the dividend go up. So that's because it's selling a 0 DTE option every day. It's going to always be capturing these VIX spikes. And the more the VIX spikes, the worse it is to be a 0 DTE option holder. Okay? So that's the sell side. Very interesting. Let's look at the buy side, because this is where we can do a little quick education on the options Greeks. They're getting this exposure to sell these 0 DTE options, which we'll get into what they sold, by buying the 420.69 call on the SPX and the 520 call on the SPX. This one expires for March, the March quad witching. This is the June quad witching of 2025. So we can already see, if I'm talking about the March quad witching in 2025, don't say, oh, Pop, you're this is just some esoteric stuff. No, we can see in this fund that this is a major expiration date. We already know this in early August, mid-August. This is going to be a major expiration date. We already know the June 20th quad witching. Just ask NVIDIA traders is going to be a major expiration date. Go check out that video and have fun calling all that coincidence. So how are they getting this exposure? Well, they're not using SPY, but I just wanted to show very similarly what they're doing. So the 420.69 call, we're just going to show how much money the fund saves by buying a deep in the money option. This option is so deep in the money that if we look at it, we're going to see something pretty interesting. It has a 93.6% chance of expiring in the money. That means only roughly 6.4% of the option is time value. That's very interesting. Only 6%-ish of this option is time value. The rest of it is just like owning 93 shares of the S&P 500. It's literally not different at all. And the closer we get to the expiration date, this delta, unless the S&P 500 crashes, is going to only get higher. All else being equal, as the expiration date approaches, the delta is going to get higher. So that on the expiration date, if the option's in the money, it's guaranteed to have a delta of 100. Right now it has a delta of 93.6. So how much money does this fund save by not saying, I will never trade options no matter what? Well, I took 93 and I multiplied it by the premium for that contract, which was 131.20. And so we get that option cost $13,120. That's how much the option costs to buy it. And it gets the exposure of owning 93 shares of the S&P 500. In this example, we're using SPY. So 93 times the current price of SPY, which is 554, is 51,522. So that's how much it would cost to get the exact same exposure without options. This is how much it costs to get the exact same exposure with options. We're saving almost, what's that? Almost $35,000 to $40,000 being saved to get the exact same exposure. So when we compare this fund to ISPY, we're going to see not only a higher yield, but also a higher total return. Why? Because they're selling the exact same options, but they're getting the exposure through different ways. This ETF, yes, there's risk associated with the options market. If the CBOE gets cyber attacked, or retail traders are dumb enough to believe that Roaring Kitty is actually the one who broke the financial system, then this fund has very similar risk to the YieldMax funds. This is not a fund to be holding if I'm right about doomsday. Not because the S&P 500 is going to go splat, but because the options market is going to be something that, you know, we've never really seen a cyber attack on the CBOE. That's really one of the only things that can, it's honestly the biggest advocate against this ETF. I'm just gonna say that. That's really the only way someone could convince me that this ETF is worse than owning the S&P 500 SPY is in the event of a cyber attack on the CBOE or the New York Stock Exchange. That would really even be the only time I present that. That's why I mentioned that. And that's why I talk about some of these scenarios too, because I really see, especially now that we're getting delta neutral, it's very easy to get delta neutral with this ETF, but just even getting delta neutral through buying multiple ETFs is now something that's possible because there's ETFs that sell puts, there's ETFs that sell calls. That's called a short strangle and a short straddle. That's never been active to people. Anyway, let's get into this presentation. I wanted to get some of that math out of the way. Now we can get into the fun part. King XDTE and the Knights of Roundhill, they're beating the market and they're yielding 34.88%. Your CFA, your retirement pension people, they don't want you to know this, fam. They don't want you to know this. This is why they tell me I have to act crazy. Pup, you gotta act crazy. You know, you gotta be very selective about who sees this information. We need all the people who don't believe in the truth to unfollow you. You can't just make them, you know, privy to information like this. What is XDTE? And obviously I'm talking about information that's publicly available through this website, these websites. That's the only information I'm talking about, obviously. What is XDTE? An ETF that gets 100. This one actually gets 93 delta in the option that we saw they buy another call to. So it could be 93 delta. Be a little more accurate. Really though, that option's so deep in the money, and each day we get closer and closer to expiration, the delta is going to be 100 unless SPY goes all the way down below 420 by March. Not saying it can't happen. I'm just saying. Compared to owning the S&P 500, let's just go through that scenario real quick. Yeah, let's just go through that scenario. Okay? Last one. Let's go through that scenario where the stock market crashes, but it's not a black swan event. It's not a cyber attack on the CBOE, and it's not a cyber attack on the New York Stock Exchange. Maybe it's monkeypox, right? So it has nothing to do with a cyber attack on the CBOE. The options market is still working perfectly fine. An investor who got the exact same exposure to the S&P 500, not only do they have no dividend to protect from it, I guess they got like a 1 point something dividend to protect from it. This ETF is going to keep capturing higher and higher options premium every day. as the VIX goes up. This ETF, the dividend's probably going to get lower because of recession fears. And this investor had to pay a lot more for the shares. Way more. Almost 4 times more for the shares. So this person's got a much smaller loss during the crash scenario. And they're going to get a growing, we see, the dividend grows. The dividend grows when the VIX spikes. Holy hedging. Holy hedging. Hedgely moly. This dividend is growing each week as the VIX spikes. This is crazy. But dividends are a scam, puppy trades. So XDTE, it gets 93 delta exposure with a deep in the money call, then sells an out of the money covered call against the position. The fund, not in theory, the fund saves money by using a deep in the money call on SPX. Instead of buying 100 shares of SPY, they sell out of the money call options against this position with a ratio that allows for upside participation. So that ratio, maybe not the best way to say it, but just what they're talking about with using that inherent market mispricing every morning. So they're still getting the overnight exposure. This is what's so cool. They're still getting the overnight exposure. All those SPY gaps, they capture all that. They're still getting the overnight exposure. Then every morning, you know, if you're dumb enough to buy a 0 DTE call at the open, you know, this is kind of the casino. I mean, that's the casino trade. You're literally like the guy walking into the casino for the first time, telling the dealer you don't know how to play blackjack. And you're basically just giving away your money for free if you buy a 0 DTE option. So this is kind of like the casino thing. I live in a state where gambling is legal. My friends go to the casino. They always ask me if I want to go. I'll go visit with them. But this is the casino. I mean, there's not a bigger casino than this. Someone trying to buy a 0 DTE option on SPY that's out of the money every morning. I mean, that guy's got a problem. He's definitely not going to be making money. XDTE versus SPY on the blind average test. Numbers don't lie. I know you guys don't like this. There's a lot of people that don't like this. They're not happy about this. They want to live in this. You know that scene in The Matrix where Morpheus is saying, these people will protect the Matrix. They need to. They have to. They've got so much of their 401k in the S&P 500 yielding 1 to 2%, and their fund managers have trapped them in there. And they can't touch that money until they're in their 60s. So they need to fight for this to not be a reality. They need to fight for this to not be a reality. Because they kind of got duped. This is kind of showing how that whole thing where people say, oh, we're just giving our money away to fund managers, and they're holding it, and it's free money because we get a match. That's kind of horse caca. And people don't like realizing that for 15, 25, 30 years of their life, their hardest working years, they've been getting scammed. A free match in the 401k? I mean, people actually believe this. It's yielding 1 to 2%. Ay, ay, ay. We got 14.16% total return on an ETF that pays a 33% dividend weekly versus an ETF that pays like a 1-point-something% dividend, has a 6.72% total return, less than half of XDTE when it's blindly averaged into. So FEPI and YMAG, they are more risky because they're holding tech stocks. That would be my justification for saying they're more risky. FEPI is actually holding them. YMAG has a very similar thing where it's using options to get this exposure. So it's got that black swan CBOE cyber attack risk. So when you guys read my post about this stuff, you're like, oh, it doesn't have anything to do with the stock market. I'll tell you what, you go tell someone who has their master's degree in finance that the New York Stock Exchange getting nuked, or the New York City, or Chicago Board of Options Exchange, something happening with a cyber attack or an American adversary, you go tell them that has nothing to do with finance, they're going to look at you funny. So YMAG has that risk. FEPI and BALI, they actually do own the shares of the underlying in a black swan event. Theoretically, it's It's got shares of ExxonMobil, JP Morgan, and Apple. Those companies have buildings and assets somewhere. Anyway, XDTE, they've got options. Same with YMAG. JEPI and JEPQ. I mean, these are the OGs, right? So when I did that King Arthur theme, you know, this is the new king, right? The old king, remember, this is the new king in a trough right now because the market's dipped. This is the new king in a trough. Remember, we had to worry about this trough because of the Japanese currency crisis. And now the Japanese banks are all adopting Ripple. Ripple, the bridge currency. So we need to worry about the Japanese liquidity crisis during this really dangerous trough. You know what I mean? So JEPQ and JEPI blindly averaged into, they're getting destroyed by XDTE. On a total return standpoint and a yield standpoint, JEPI is probably less risky. It owns safer stocks. JEPQ, it's probably riskier. It tracks the NASDAQ. And so that's why we've seen JEPQ and FEPI, they're actually negative in this March to August period on the blind average test. Okay? So comparing this to ISPY from ProShares, this sells 0 DTE covered calls. Both of these expense ratios are 0.35. That's going to be less than 0.95, but the yield's dramatically lower. The total return's lower. ISPY from ProShares sells 0 DTE covered calls with swap contracts, way lower yield. Why? Because they're actually owning the underlying instead of using options to get exposure. Can Leap? So this is the question I had. We see the total returns for ISPY still lower, still half of XDTE. I think Roundhill pulled a sword out of the stone. I don't think this is new and shiny. I think Roundhill pulled a sword out of the stone. The only way this is riskier than SPY and the expense ratio couldn't be justified is in the event of a cyber attack on the CBOE and the NYSE or something of that nature. Can calls on SH and Leap puts on a leveraged ETF on SPY that tracks the S&P 500 create a low variance position with a net credit if this option position, this long option position, was paired with XDTE? Would it be possible to make a delta neutral position by buying a call on SH or a Leap put on a leveraged S&P 500 ETF, pairing that with shares of XDTE to collect a large dividend that is quote unquote without risk or with low variance? Let's see how many likes this video gets. Let's see how many subscribers this video gets. We might answer that question in a future video. Devil's advocate and final thoughts. XDTE has a higher expense ratio than SPY, 0.95 versus 0.0945. This expense ratio is lower than most closed-end funds that sell options. That's an interesting point. Doing almost 33% higher yield and better total returns make up for this. I think it does. SPY holds the underlying stocks in the portfolio, whereas XDTE doesn't. In a black swan scenario where the CBOE or the NYSE is cyber attacked, XDTE has a similar risk as the yield max funds, where options risk detailed in the prospectus comes into play in a way that is frankly unprecedented. How does XDTE pair with ETFs like SVOL or a possible profitable combination of short strangles on NVIDIA, Tesla through YMAX ETF? So all that means is basically NVIDIA and Tesla, over time, they're considered to be correlated with the S&P 500, but have a higher beta. So could XDTE be paired with a delta neutral position on NVIDIA and Tesla? And that's kind of like a pair trade where the high beta stuff is delta neutral. XDTE is just long and selling the 0 DTE options. I think a more accurate kind of quant way would be looking at this option, calls on SH and Leap puts on a leverage ETF to create a delta neutral position. I can get into that in a future video, provided this video does very well. How does XDTE pair with other ETFs? And finally, any CFA who says maybe a REIT achieves an 8% yield is a liar. They want to gatekeep you from dividends and option premiums income from you. That's what they're doing, especially if they work for JP Morgan. And honestly, now BlackRock, because we've got, and I'm pretty sure Schwab, they all have their own funds that use very similar strategies to BALI and JEPI and JEPQ to enhance that yield up to 8-ish%. Now we're seeing, though, the truth is coming to light. It could have been a lot higher than that. And so, it's just something to think about with that low yield. I've never seen anyone retire with no dividends. That's all I'm saying. But they've convinced a lot of people you can.